Hello, everybody. Welcome to Wednesday. The S&P 500 was down 1.6% today, the dreaded red shirt day, unfortunately. The market was kind of hanging in there, and then all of a sudden they had a Treasury auction on 20-year Treasuries. It didn't go very well. The demand was pretty soft, and the market responded, negatively to that. The yields on Treasuries went up because the price was going down. And so this is what I've been talking about actually all week, because we're in the middle of this, tax cut bill, which is incredibly important to see how the bond market looks at that tax cut bill. Everybody seems to be looking at it from a political standpoint, got to keep my promises and all that type of stuff, but none of that's going to matter if the bond market doesn't like it and starts to, melt down and create higher interest rates, which will create all kinds of different problems. So, what happens here is that, our treasury bonds are important because we have to sell them to pay our bills. We have a deficit that we run, year after year. And if we don't have that, we're going to have trouble. We wouldn't even be able to pay the interest on these bonds without being able to, continuously have a cash flow coming in from the sale of these bonds. And so when cut back on trade, one of the problems with that is that that these countries or companies in these other countries will sell something in the U.S. and sometimes they'll park them in our treasuries. So there's a cash flow that comes into our treasuries from this trade, and so the trade deficit has been vastly misunderstood here by this current administration, essentially looking at it as a bad thing. When you look at the trade deficit, so if China has more that they're selling to us than we're selling to them, that creates that deficit, but they're also then moving money into our treasury bonds. They're the third largest holder. And so you've got this situation where as you cut back on trade, you're going to cut back on demand for treasuries. You combine that with the fact that now we have a rating downgrade, the third one here with Moody's, over the weekend or on Friday last week, and you've got a situation where we've kind of made some enemies with the rest of the world here by slapping tariffs on them, and they're not very friendly with wanting to come in here. And maybe most importantly, there's some question about whether we'll be able to pay back some of these bonds if we're not running the country in a fiscally conservative manner. So if you look at this tax bill that's going out, it was being held up by a group of Republicans that wanted to increase the cap on the SALT tax. So right now, we can only write off $10,000 of our state tax and property taxes. And so if you have more than that, you used to be able to write it off, but now you can't. And so the latest proposal is to raise that up to $40,000, and it would start to phase out if you start to make 500,000 or more. And so that's great. That helps us here, but it also means more money going out the door. We've already promised, we're not going to pay tax on tips. We're not going to have tax on overtime. We're not going to have tax on Social Security. They did take that off the table. What they're going to do instead is give everybody a $4,000 increase to your standard deduction. And so that's, not a bad replacement, but all of those things are expensive. And they cost something. And so what they're proposing at the moment is they're going to do all of these tax cuts, and they're going to expire when at the end of Trump's term. So he'll be able to meet his, promises with these particular cuts, and including the SALT tax cut, basically. And that means less revenue into the country, higher deficits. So then we have to make cuts. Well, one of the big areas they're talking about cutting, of course, is Medicaid. So what they're trying to do now is take Medicaid and have it start with its cuts in 2029 after Trump is out of office here, as far as that goes. So, delaying that pain point from a political standpoint. However, what happens, of course, is you end up with a much bigger deficit here over the next 4 years. And the stock market, it's going to respond to the bond market, which isn't going to like that concept. So after they negotiated out this $40,000 cap on SALT, the conservatives in the Republican Party kind of revolted now, and they won't vote for this because there's too much tax cut and not enough savings cuts. And they want that Medicare to start the cuts in 2026 instead of 2029. And so, they're having some meetings and going through this. So you look at what those conservatives are asking for, it is going to be a pretty big disaster, in my opinion, for a lot of people that are relying upon Medicaid. However, they're at least looking at things from a fiscal standpoint. They're probably the best friends of the bond market right now. You pass a bill that the bond market doesn't like, and you could have real big problems. Just ask Liz Truss. She tried to present a tax cut in England. The bond market literally froze up there. The Bank of England had to step in, and you've got this situation where you could have some real problems. And we already have Treasury auctions that are going off where the Federal Reserve is buying some of those bonds that are going out, that quantitative easing concept. And, it's interesting. They never mentioned they were doing quantitative easing in the different conferences that they've had. But I mentioned this, a couple of weeks ago. We've been seeing the balance sheet start to grow. It was coming down where they were selling off their bonds. They call that quantitative tightening. But they've been doing some quantitative easing to try to support, the economy at this point in time, which is probably not a bad idea. But it's a little bit of kind of a phony scenario where you're buying your own bonds and kind of just creating more, a currency that way to a certain degree. So uh, this is going to be super important. Somehow we have to get the confidence of the world back so they continue to buy our bonds because you got people like Jamie Dimon who pretty accurately called the 2008 downturn, who's now talking about some of the same things happening here in this particular environment. And so he's being listened to, and the market's been really soft, if not down, since he started talking. And so what he's worried about is exactly that. You can't you can't take tariffs and make them six times higher and then expect to have no inflation. You can't expect retailers to absorb all that. They don't have that much margin to absorb all that. And if they do absorb some of it, all of their stock prices are going to tank just because their earnings are going to fall, and there'll be this continuous possibility of kind of a rolling scenario where things could get worse. And so that's why we haven't added all of our money back into the portfolio because we really want to see how this is going to play out. And so today's Treasury bond market auction, I think was important. It was kind of a must-watch thing for the day, as far as I can tell. But and so that's what has to happen. Hopefully, the feedback loop that they'll get into this bill that they're trying to pass here will start to make some sense. We can't just meet campaign promises if the bond market's going to melt down. It doesn't matter. Bond market wins. And a matter of fact, the big Liberation Day tariffs with the really, really high tariffs on all the countries in the world, the bond market started to melt down. And that's why we got that big pause. And again, we're already high enough. Hopefully we don't go higher on these tariffs as far as that goes. I don't think that there is a connection being made by everybody that's in power trying to make these decisions about how all this stuff works. And again, you put this type of pressure on the system, you get a Lehman Brothers failing, which is what happened in 2008. And that's essentially what Jamie Dimon called, was that, things were really heating up in terms of the pressure inside the system. And you could have a fiscal, nightmare come at us. So hopefully none of this happens. There are some people out there, these ultra conservative, they're called, this group from the Republican side in the House, and the House has such a thin majority, just four people can basically dominate the conversation. There's a lot of pressure placed on them to go along anyway. But boy, again, you can't force through something that the bond market won't like. So that's why we're all watching the bond market right now to see how things go, because the combination of tariffs, which could cause inflation, which affects the bond market, combined with the situation with the tax cuts, is going to be put some pressure. And unfortunately, the bill that they're talking about right now actually has a deficit built in. They're kind of running around talking about there's no deficit in there. It'll actually be net positive. No, not when you really look at all the different bipartisan groups out there that are doing the analysis. It's about $3 to $4 trillion of deficit, and that's assuming there's no recession. It's assuming things work out. Like I say, 2017, running around talking about that tax cut that was going to be neutral. It didn't become neutral. Our deficit's much higher. The pandemic was part of that, but it was already starting to go up quite a bit before the pandemic. So again, this reconciliation process is always fraught with just bending little numbers around to try to get what you really want out of it so you can get it through there. But again, you can't mess around with the bond market. You can't fool them in that regards. And so, having a soft treasury auction is not normal for the U.S. Happens once in a while. Maybe this is just a fluke. We'll see what happens. Earlier auctions this week went okay. But this is something that everybody's watching for, and is why the market responded, immediately to what happened there. If you look at the chart, so we'll find out how this goes going forward. But we're going to continue to stay in our conservative stance. Continue to take a look at what we can do to protect ourselves if things continue to do poorly, and hope for the best, and hope that these tariffs really don't have an impact. That's possible. We're not a goods society anymore. We're a service society. Hope that this tax cut actually has some offsetting economic impact in terms of money that's now being not spent on taxes by consumers that could come into the economy to maybe offset some of these tariffs. I mean, there's some scenarios here that could work as far as that goes. And of course, the tariffs are optional. They're not mandatory, and they can be changed, and they have been changed. They've been lowered for the most part from their highest points as far as that goes. So that could happen too. You could have more realization for what that impact is as that happens, and maybe those tariffs start to come back down, or there's more carve outs or whatever there might be. So, we have a ways to go to see if this is going to be a positive or a negative situation. But these are the things that are out there that are, different than they were, just a year ago as far as that goes. So, anyway, look forward to being able to see what we're going to be doing tomorrow, and we'll talk to you then. Thank you.